In 1985, the Australian middle class was handed a contract. It was not written down anywhere, it was not signed, but it was real. And for 2 generations, it was treated as sacred. The deal was simple. Buy property, leverage it, hold it, and the tax code will reward you for the rest of your working life. Negative gearing to write losses against your wages. A 50% capital gains discount when you sell. Family trusts to split income across households. Super concessions to compound it all into retirement. 4 pillars, 1 promise, 40 years of political consensus. And in this year's budget, the Albanese government walked into the House of Representatives and tore 3 of those 4 pillars onto the floor. And almost nobody is asking the right questions right now. Today, I'll walk you through exactly what is broken, the 3 Western economies that already lived through their own versions of this, and where this budget actually sits inside the 18-year cycle. Because every promise a politician makes has an expiry date, and each time this happens, it brings us one step closer to the inevitable end of the cycle. But most importantly, I'll also tell you why this Australian budget is just the opening move of a much scarier global game, and how the rest of the main Western economies are reacting to it right now. All right, guys, hit the like button and subscribe to the channel. And if you want the full framework on the 18-year cycle, the 3-part free mini course is at the top of the video description. So let's get straight into the data. The 4 pillars are never sold as loopholes. They were sold as a deal. Negative gearing in its modern political form dates back to September 1987. Paul Keating had quarantined it in 1985, and the property lobby ran a 24-month campaign claiming rents were exploding because of the change. The Hawke government folded. From that moment forward, negative gearing was treated as untouchable by both sides of politics. The 50% capital gains discount came next in 1999 under Howard. It replaced the old Keating-era inflation indexation system with a flat half-off rate on any asset held longer than a year. Discretionary trusts had been doing the quiet work on the background for decades, splitting income to family members in a lower bracket. And super concessions tied the whole structure together, taxing contributions and earnings at 15%, while wages were taxed up to 47%. That was the deal. 2 generations built their retirement around it. Roughly 1.1 million Australians today own a negatively geared property, and about 70% of them own just one. These are nurses, teachers, small business owners, not a property tycoon class. Just households who took the contract at face value. And here is the line that matters before we get to what changed. During the 2025 federal election campaign, Anthony Albanese explicitly ruled out changes to negative gearing and the CGT discount. Explicitly, on camera, multiple times, lying, of course, they're politicians. So when the Treasurer stood up last Tuesday, the audience knew exactly which contract was about to be ripped up. Now here's what actually happened. 3 pillars, 1 budget, 1 night. Pillar 1, negative gearing. From July 1st, 2027, negative gearing on residential properties is restricted to new builds only. Properties already owned before 7:30 on budget night are grandfathered. You keep the old treatment until you sell. But every new investor buying an established home after that cutoff loses the ability to deduct rental losses against wage income. The cost to the budget had ballooned from $6.7 billion in 2014-15 to a projected $12 billion this year. That's on track for $14 billion by the mid-2030s. That is a figure that finally broke the political will to leave it alone. Pillar 2, CGT discount. The flat 50% discount is gone for assets acquired after budget night. In its place, a return to inflation indexation, taxing only real gains above CPI. On top of that, a 30% minimum tax floor on real capital gains. The Treasurer named the number directly in the speech. The CGT discount was costing the budget nearly $22 billion in foregone revenue this financial year alone. 83% of that benefit was flowing to the top 10% of income earners. It's 83%. The political cover for breaking the promise was hiding inside that single statistic. There is one carve-out worth noting. Investors in new residential builds can still choose between the old 50% discount or the new indexation model. The whole architecture is designed to push the capital out of established dwellings and into new supply. Pillar 3, discretionary trusts. A 30% minimum tax rate applies to discretionary trusts distributing from July 1st, 2028. Super funds, fixed trusts, disability trusts, and charitable trusts are exempt. The target is the income splitting structure that wealthy families have used for decades. The government's own data showed that the top 10% of households hold more than 90% of private trust wealth. Pillar 4, super, was largely left alone. The one piece of that original contract that wasn't touched, which means after Tuesday night, super became relatively more attractive than every other tax-favoured structure in Australia. That contrast is going to matter later in this cycle. The total revenue raised across the package, $8 billion over 4 years, partially offset by a $250 working tax offset for 13 million workers, an income tax rate cut from 15 to 14% on the lowest bracket, and a $1,000 instant work expense deduction. That's the trade. Wage earners up, leveraged investors down. That's what happened. Now, here's the part almost no other channel will tell you. This isn't only an Australian story. 3 Western governments have already faced the exact same political pressure point Australia just walked into. 3 different vehicles, 1 identical mechanism underneath. Mirror 1, the United Kingdom. Section 24 of the Finance Act, introduced by George Osborne in 2015, phased in from April 2017, fully effective by April 2020. Before Section 24, UK landlords deducted 100% of mortgage interest from rental income. After it, mortgage interest stopped being a deductible expense entirely, replaced by a 20% basic rate tax credit. The mechanism was different from negative gearing, but the political logic was identical. Curb the leverage investor before the voter revolts. The outcomes are now on the record. Between late 22 and March 25, the UK lost roughly 115,000 buy-to-let mortgages, which is a 5.6% contraction. Savills counted 170,000 property sales subject to capital gains tax in 23-24, more than double the level a decade earlier. That is a forced exit at scale. Buy-to-let incorporations exploded from 24,000 in 2017 to 47,000 in 2021. More BTL companies were set up between 2016 and 2020 than in the previous 50 years combined. The market did not collapse. It professionalized, contracted, and of course, rents went up. Mirror 2, Canada. April 24, the federal budget proposes raising the capital gains inclusion rate from 50 to 66% on corporations, trusts, and individuals above $250,000 threshold. Tax the leveraged investor. Protect the modest holder. Then something interesting happened, as it always does. In June, the implementation date triggered a massive wave of preemptive selling as investors crystallized gains at the old rate. The Parliamentary Budget Office flagged the distortion. In January 25, the implementation was deferred. March 25, new Prime Minister Mark Carney cancelled the proposal entirely. Same mechanism, same logic, but Canada blinked. Australia did not. Mirror 3, the United States. At the federal level, no capital gains hike was enacted, but the pressure is building from a different angle. The Trump administration secured a carve-out from the OECD's 15% global minimum tax framework, becoming the only jurisdiction with a side-by-side regime. That move has a second-order consequence almost nobody has priced in. If the US opts out of harmonized corporate tax, every other Western treasury loses the cushion that international consensus was supposed to provide. Which means the pressure to raise revenue from domestic capital and leverage property from contracted wealth lands harder on every other Western government. 4 governments, 4 different vehicles, 1 identical pressure point. Tell me that's a coincidence. They've all tried it, looks like they're all backing out. Now, most of the commentary on this budget is asking the wrong questions, obviously in my opinion. They're asking if it's a good policy or a bad policy. The right question is, where in the cycle does a budget like this normally appear? And how do we prepare for the inevitable? This is where Phil Anderson's framework earns its keep. So this is a brief explanation to those new to this channel. The 18-year cycle, refined by Anderson and originally sourced by Fred Harrison from over 200 years of US public land sale data, has tracked credit expansion and land speculation through every major Western boom and bust since 1800. It's 14 years up, 4 down. The final 2 years of the up phase is the period Anderson calls the winner's curse. Fred also called it the winner's curse. That's where speculative behavior goes vertical, where every retail investor mistakes cycle-driven gains for personal genius, and where governments finally start trying to contain what the market has not yet contained itself. The last cycle bottom was 2012. The mid-cycle slowdown landed in about 2018 to 2020. By the maths, the winner's curse phase covers roughly 2025-2026. And on May 12, 2026, the Australian government delivered a budget targeting the exact tax incentives behind late cycle leverage property speculation. Now, I want to make the next 3 points really clear, because from what I'm seeing and reading in the media, coverage of this they're getting a lot of things mixed up. So point one, this is not a budget trying to ignite a housing boom. It's a budget trying to cool investor demand in established dwellings and redirect it into new supply. That is the opposite of a classic early cycle budget, which encourages credit, construction, and asset reflation. Early cycle governments hand out tax incentives, late cycle governments take them away. Two, by the time governments seriously target tax-favoured property speculation, the boom has already matured. Look at the data Australia is now sitting on. National median home value of approximately $920,000 in March of this year. Sydney median at 1.3 million with houses well above 1.6. Price to income at 8.2 nationally, 13.8 in Sydney, ranked second least affordable city on earth behind Hong Kong. 10.6 years to save a deposit. Insane. Mortgage repayments consuming 45 to 48% of the median household income for new buyers. A solo buyer on an average full-time wage cannot purchase a typical house in an Australian capital city. Hasn't really changed for many years now, has it? Household spending a record 33% of pre-tax income on rent. Look at me in the eyes and tell me that's sustainable. I don't think anyone's going to tell me that's sustainable. Read number 3. This may reduce melt-up intensity, but it does not remove cycle risk. Investors will rush before the rules change. We're watching that happen in real time now. So we will see some delayed purchases. Some will rotate into other assets. And UBS already is publishing a note suggesting capital will shift from property into shares. New build demand is favoured by the policy, so expect a transitional supply spike before that cools too. First home buyers get relative help, but if credit remains available, they may simply replace investor demand without changing the underlying price dynamic. So here's the one big thing I want you guys to understand. The budget is anti-winner's curse in intent, but potentially winner's curse confirming in timing. The government is trying to stop late cycle buyers from overpaying for land with excessive leverage. But the fact that such measures are now politically necessary is itself the evidence that the cycle is obviously maturing. Now let me be very clear about what this budget is and isn't. It's not a crash trigger. It shouldn't send everyone into panic mode, but it is definitely a cycle marker. The RBA cash rate is sitting at 4.35%, which recently just went up, with hikes through February, March, and May of this year already digested by the market, or getting slowly to it with the last one. Inflation is forecast to peak at 5% mid-year, partially driven by the oil shock running through every Western economy right now. Growth is slowing from 2.25 this year to 1.75 next year. April 2026 just printed the first national price decline in months at negative 0.1%. The cycle may already be doing its own work before the policy even takes effect. The bottom line is this. Australia is sitting in the late cycle policy reform phase. This is where governments begin trying to contain the consequences of a land boom before the market does it for them. Sometimes they succeed in slowing it down, sometimes the cycle wins anyway. New Zealand tried this exact playbook back in 2019, phasing out interest deductibility on residential property. Rents climbed, affordability did not improve. By 2024, the government was reinstating interest deductibility to address the supply problems the original reform had not solved. That is a risk Australia is now running. In Anderson terms, this is the late stage winner's curse era policy reform. It does not invalidate the framework, it actually supports it. Land has become expensive enough, politically toxic enough, and structurally distortive enough that the government is finally targeting the tax incentives behind speculation. And if you want the full breakdown of how the 18-year cycle has tracked these policy reforms, moments across multiple countries, multiple cycles, the free 3-part mini course walks you through all of that. Part 1 is the cycle itself and why it has repeated for over 220 years. Part 2 is where we are right now in the timeline. And then part 3 is how to exactly position for what comes next. The link to that is in the top of the video description. Now, I want to hear from you guys. Australia went first this week. The UK already did its own version. Canada moved last year and pulled back. So which Western government breaks the same promise next? Does the United Kingdom go further on CGT and stamp duty in its next budgets? Does Canada come back for a second attempt under the different government? Or do Germany, the Netherlands, Spain finally move on housing as the affordability crisis tips into a political crisis? Or does the United States finally face a state-level reform that eventually hits the entire world economy? Drop your country and your call in the comments section. I'll be reading every single one of them and trying to reply to as many as I possibly can. And one more question before I go. How much margin of safety do you have between you and your government if your government breaks the same promise? Because at the end of the day, this is not a whole story just about Australia. It's about the position every Western leverage investor is now sitting in, whether they realize it or not. So hit the like button, subscribe to the channel, grab your free 18-year cycle mini course, links in the top of the video description, and I'll see you guys back at the next video. Till then, take care and peace out.